Housing and Urban Affairs will come to order. This hearing will be in the hybrid format, as we've done many times. The witnesses in person, the senators can go either way, and my Senate colleagues will be done by seniority, whether you're here or whether you're remote at the gavel. So thank you all for joining us. Yearning for a return to normalcy, millions of American voters elected Joe Biden president of the United States more than a year ago. The American people were exhausted by the divisive rhetoric at neighborhood functions, at church gatherings, at family dinners. They wanted someone who would bring this country together based on our shared values, like the dignity of work. They wanted an economy that works for everyone, not just wealthy elites. That is what we're delivering. Think of where this country was a year ago. Domestic terrorists breached this building a year and a week ago and assaulted our democracy. 4 million more people were out of a job. The hope of vaccines for everyone was just that, a hope. Today, we have made much progress. We have a president committed to democracy, willing to stand in the breach, as he put it last week. Vaccines and booster shots have dramatically lowered the risk for most people, allowed Americans to go back to work, and our children to go back to school safely. We added 6.4 million jobs last year, 6.4 million jobs, the most since 1939. The nomination we consider today represents another step in President Biden's efforts to rebuild our economy. The president is putting results over partisanship, evidenced by the gentleman sitting at the table, renominating a Federal Reserve chair of the other political party. Jerome Powell served as chair of the Federal Reserve since 2018. He joined the Fed in 2012. He served the country before that in a number of different roles, Undersecretary for Finance at the Treasury Department during the George H.W. Bush administration. As chair, together with President Biden, he helped us deliver historic economic progress. We passed the American Rescue Plan, putting shots in arms and money in pockets. The unemployment rate dropped to 3.9%, down from 6.7% when President Biden raised his right hand. In December alone, we added 800,000 jobs, more than doubling economists' expectations. The economy has regained 84% of the jobs we lost since the pandemic hit 2 years ago. And for some of my colleagues who like to measure the strength of the economy only by the stock market, it was up 20% at the end of 2021. It last year hit record highs 70 different times. We passed an historic jobs bill, the bipartisan infrastructure package, a goal that presidents for decades, presidents of both parties, failed to reach. Chair Powell, along with Vice Chair nominee Lael Brainerd, whom we'll hear from later this week, led the Federal Reserve's unprecedented actions to stabilize our economy in the face of a global pandemic. To his credit, Chair Powell recognized the importance of full employment and what that means for all workers, particularly those at the margins of our economy. He held firm against attempts to politicize the Fed and prevented an economic downturn from becoming far, far worse. He understands the best way to bounce back from this crisis is to get the coronavirus under control with vaccines. Today, we're at a critical moment. For the first time in decades, workers are finally starting to get a little bit more bargaining power. Wages are growing faster than inflation, faster than we've seen in over a decade. Americans are leaving jobs that didn't work for them and their families. They're finding better ones, often with higher paychecks. Corporations call this, quote, a labor shortage. To me, it looks like the free labor market at work at its best. Of course, we still have challenges. We've seen severe supply chain disruptions caused by the pandemic because for decades, corporations put short-term profits over long-term resilience, lobbying this body for what turned out to be bad trade agreements and bad tax policy. The fragile supply chains stretching all over the globe are not easily fixed. These disruptions, along with corporate opportunism, are raising the cost of many consumer goods. That adds to the costs that have been growing more unaffordable for decades, from child care to prescription drugs to housing. While paychecks are starting to go up, wages are still far from keeping up with corporate profits. We've only just begun the work of empowering American workers in reorienting our economy from Wall Street to Main Street. Some are suggesting, though, that the Fed pull back on the support of the broader economy and make it harder for people to get jobs. That's generally what happens. Economist lingo tends to mask what we're really talking about when it comes to the Fed's work. So let's be clear. President Biden put it pretty well last week. Taking the example of the price of cars, he said we have two options. We can increase the supply of cars by making more of them, or we can reduce demand for cars by making Americans poorer. That's the choice we face. When people talk about cooling off the economy, what they really mean is making it harder for people to find jobs and stopping paychecks from growing. And we know how this goes. The cooling off never seems to extend to corporate profits or executives' pay. The Fed must not allow only Wall Street to recover while working Americans are left behind. We've seen that story unfold far, far too many times before. Today, banks are quietly celebrating one of their most profitable years ever with huge bonuses and payouts. The Fed must do more to stop consolidation in the banking industry from hurting consumers and small businesses. It must encourage more lending to Main Street and crack down on stock buybacks and risky bets at the biggest banks. And the Fed needs to take seriously the systemic risks that threaten our economic progress, like cryptocurrencies and stablecoins, and most importantly, climate change. Chair Powell's shown he understands, in his words, profound challenges for the global economy and financial.
Collapse of the banking system, we now know that's clearly empirically false. After the pandemic caused the economy to nearly collapse, our country emerged with the most well-capitalized banks in history. It was and still is abundantly clear that those regulatory reforms did not come at the expense of financial stability. Of course, none of the Fed's pandemic actions came without a cost. This negative real interest rate environment continues to distort markets, risk asset bubbles, and punish savers. And the Fed has dramatically expanded its balance sheet with trillions of dollars in government bonds, effectively monetizing a lot of debt and facilitating profligate government spending. For the past 18 months, I cautioned that the Fed was fighting the last war, a mystery pathogen that led governments to collectively shut down the global economy when, in fact, a new enemy had arrived, and that was inflation. I'm relieved the Fed has acknowledged inflation is running well above and longer than its initial projections. In response, the Fed has accelerated the termination of its bond buying program, and FOMC participants appear to be accelerating the process to normalize interest rates. These are welcome developments. But I do remain concerned with the Fed's actions going forward. First, I worry that the Fed's extraordinary response to the crisis could become the new normal for monetary policy. We're more than a year into a record economic expansion, with unemployment at near all-time lows, and yet the Fed is still today buying government and agency securities. Having continued QE throughout the recovery was, in my view, a mistake. It's contributed to asset bubbles, distorted markets, and a suboptimal allocation of capital, credit, and resources, all of which ultimately lead to lower economic growth. Second, I worry that the Fed's new monetary policy framework has contributed to the Fed being behind the curve, as we are seeing inflation running at a 39-year high. Under this new framework, the Fed intentionally tolerates above-target inflation for an indeterminate period of time. Under the old approach, the Fed may have acted last April when we first passed a 4% inflation rate. We haven't seen that in some time. Beyond monetary policy, I'm deeply concerned to see the Fed, especially at the regional banks, wade into politically charged areas like global warming and so-called racial justice. Regional banks have hosted multiple symposia on these issues that consistently embrace and advance a particular liberal political agenda. And the Fed itself joined the network of central banks and supervisors for greening the financial system. The network's stated aim is to use financial regulation to, and I quote, mobilize mainstream finance to support the transition toward a sustainable economy, end quote. In other words, to direct credit away from the fossil fuel sector. The troubling politicization of the Fed puts its independence and effectiveness at risk. The Fed has been granted operational independence to protect monetary policy from short-sighted political interests, and in turn, the Fed has operated largely apolitically to great effect. There's a kind of bargain here. The Fed is given independence on the assumption it will only engage in areas in which it has a mandate. That makes sense. But if the Fed is going to stray from its mandate and become a political actor advocating a certain set of social policy, then there's no way it's going to maintain its independence from the political branches of government that are actually responsible for those topics. The Fed does not have a mandate to advance politically charged causes that are irrelevant to its mandate, like global warming or advancing so-called racial justice. And to make matters worse, when I've sought to understand these developments at the regional banks, I've been met with unacceptable noncompliance with reasonable requests. So let me be clear. If this politicization continues unchecked, it will not end well for the Fed or for independently driven monetary policy. As the Fed's leader, I hope you take this seriously and rein it in to protect the Fed's legitimacy and independence. Now, I've observed that the Fed has had the good sense to adjust its behavior as the facts and circumstances regarding inflation have come in differently than were expected. Unfortunately, we've seen no such humility or recognition of reality from the Biden administration or our Democratic colleagues. They appear set on making the inflationary problem worse, further causing declines in real wages, with more reckless spending that gooses demand and regulatory and protectionist policies that limit supply, that in combination ultimately push prices for basic goods higher. The crisis we face now is inflation, complicated by policymakers who unwisely behave as if it's still March of 2020. The Fed cannot correct for policy failures like school closures and government-induced business shutdowns or misguided expansions of the welfare state, nor should it try. Chairman Powell, the role of the Fed chairman is crucial for our shared economic prosperity. I was encouraged to see your renomination, and I hope that you will do everything in your power to ensure that the Fed operates within its limited mandate to effectively support the American economy.
Thank you, Senator Toomey. Chair Powell, please rise. Raise your right hand, please. Do you swear or affirm that the testimony you're about to give is the truth, the whole truth, and nothing but the truth, so help you God? Do you agree or to appear and testify before any duly constituted committee of the United States Senate? Thank you. Please be seated. Chair Powell, we welcome you to the committee. If you'd like to introduce family or friends, feel free. Please begin your testimony. Thank you.
Thank you. Is this on? Yes, thank you. I didn't bring any family or friends here today in light of the limited seating circumstances, but I will mention them in my testimony. Thank you. Chairman Brown, Ranking Member Toomey, and other members of the committee, thank you for the opportunity to appear before you today. I'd like to thank President Biden for nominating me to serve a second term as chair of the Board of Governors of the Federal Reserve System. I would also like to thank my colleagues throughout the Federal Reserve System for their dedication, perseverance, and tireless work on behalf of the American people. Their commitment and expertise were essential to the Fed's response to the COVID-19 crisis and remain vital to the implementation of monetary policy as our economy continues to progress. Particular thanks go to my wife, Alyssa Leonard, and our 3 children, Susie, Lucy, and Sam. Their love and support make possible everything I do. My 5 siblings are all watching, or will later claim to have watched, and we are thinking of each other and of our parents today with love and gratitude. 4 years ago, when I sat before this committee, few could have predicted the great challenges that would soon become ours to meet. On the eve of the pandemic, the U.S. economy was enjoying its 11th year of expansion, the longest on record. Unemployment was at 50-year lows, and the economic benefits were reaching those most on the margins. No obvious financial or economic imbalances threatened the ongoing expansion. But this attractive picture turned virtually overnight as the virus swept across the globe. The initial contraction was the fastest and deepest on record, but the pain could have been much worse. As the pandemic arrived, our immediate challenge was to stave off a full-scale depression, which would require swift and strong policy actions from across government. Congress provided by far the fastest and largest response to any post-war economic downturn. At the Fed, we used the full range of policy tools at our disposal. We moved quickly to restore vital flows of credit to households, communities, and businesses, and to stabilize the financial system. These collective policy actions, the development and availability of vaccines, and American resilience worked in concert, first to cushion the pandemic's economic blows, and then to spark a historically strong recovery. Today, the economy is expanding at its fastest pace in many years, and the labor market is again strong. As always, challenges remain. Both the individual shutdown and the subsequent reopening of the economy were without precedent. The economy has rapidly gained strength despite the ongoing pandemic, giving rise to persistent supply and demand imbalances and bottlenecks, and to elevated inflation. We know that high inflation exacts a toll, particularly for those less able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to achieving our statutory goals of maximum employment and price stability. We will use our tools to support the economy and a strong labor market and to prevent higher inflation from becoming entrenched. We can begin to see that the post-pandemic economy is likely to be different in some respects, and the pursuit of our goals will need to take those differences into account. To that end, monetary policy must take a broad and forward-looking view, keeping pace with an ever-evolving economy. Over the past 4 years, my colleagues and I have continued the work of our predecessors to ensure a strong and resilient financial system. We increased capital and liquidity requirements for the largest banks, and currently capital and liquidity levels at our largest, most systemically important banks are at multi-decade highs. We worked to improve the public's access to instant payments, intensified our focus and supervisory efforts on evolving threats such as climate change and cyber attacks, and expanded our analysis and monitoring of financial stability. We will remain vigilant about new and emerging threats. We also updated our monetary policy framework, drawing on insights from people and communities across the country to reflect the challenges of conducting policy in an era of persistently low interest rates. Congress has assigned the Federal Reserve important goals and has given us considerable independence in using our tools to achieve them. In our democratic system, That independence comes with responsibility of transparency and clear communication to keep the public informed and enable effective legislative oversight. That duty takes on even greater significance when the Fed must take extraordinary actions in times of crisis. In order to facilitate that transparency and to earn your trust and that of the American people, I have made it a priority to meet regularly and frequently with you and your elected colleagues, and I commit to continuing that practice if I'm confirmed to another term. The Federal Reserve works for all Americans. We know our decisions matter to every person, family, business, and community across the country. I am committed to making those decisions with objectivity, integrity, and impartiality, based on the best available evidence and in the long-standing tradition of monetary policy independence. That pledge lies at the heart of the Fed's mission and is one we all make when we answer the call to public service. I make it here again with force and without reservation. Everything we do at the Federal Reserve is in pursuit of the goals set for us by Congress. I'm honored to have worked in service to those ends since I joined the Fed in 2012 and as chair for the past 4 years. Thank you. I look forward to your questions.
Thank you, Chair Powell. Many working Americans are concerned about rising prices, and I think President Biden's decision to renominate you to a second term as chair shows he's confident you'll continue to lead our economy through this ongoing crisis. In November, you indicated that the rise of the Omicron variant, 586,000 new cases daily over the last week, that the rise of the Omicron variant posed significant risks to employment and economic activity. Do you agree that higher prices are related to the supply and demand imbalances that can be traced directly back to the pandemic and the reopening of the economy?
Yes, I do. For the most part, if you look back, and you can trace to developments, including strong demand and also supply constraints.
Thank you. Last year, FSOC released its report on climate-related financial risk, which describes how climate change is a threat to our financial stability. In the past, you've said, your words, climate change is an emerging risk to financial institutions, the financial system, and the economy, end quote. Will Chair Powell, will the Fed follow the FSOC report's recommendations, including implementing climate stress tests for the biggest banks?
We are looking at climate stress tests. I think it's very likely that climate stress scenarios, as we like to call them, will be a key tool going forward. I would stress that those are very different from the regular stress tests, which affect capital. Climate stress scenarios at this stage are really about assuring that the large financial institutions understand all of the risks that they're taking, including the risks that may be inherent in their business model regarding climate change over time.
Will you make this a top priority if confirmed to another term?
Yes, it will be. I would say within supervision, as I mentioned, that is likely to be a very important priority over the coming years.
The position of vice chair of supervision, but also yours.
Yes.
Okay. It's the Fed's responsibility, as you know, to promote financial stability. It means we need strong financial safeguards in place to protect American workers and families from risks in our financial system. It's all that. Chair Powell, recently the Fed has refocused its full employment objectives to make sure it includes workers of all backgrounds. Do you agree that when all workers, including women, including black and brown workers, are able to fully participate in the workforce, that our economy grows? And do you think it's important for the Fed to understand and proactively address racial and gender disparities in wealth and income and employment in our country?
So what we saw at the end of the last very longest in our history expansion was that as the labor market tightened, the benefits began to go more broadly to those at the lower end of the income spectrum and to groups that have been more marginalized from an economic standpoint. And that was seen, I think, very broadly as a highly desirable set of outcomes. So our tools do not generally have direct distributional effects, but I do think that we see now the great benefits that a strong labor market can bring to, right across the whole population and for the whole economy.
But you are suggesting from your answer that only when there is strong demand for labor, do people who are more on the margins of society, people of color, women, people who have not done as well, only then will they benefit? Does the Fed have responsibility beyond that?
Well, of course, we have responsibilities in bank supervision and community affairs and fair lending and things like that. But just focusing on monetary policy, our principal tool is interest rates, and they affect demand over time. And I do think the main thing that we can do is to make sure that, consistent with the inflation side of our mandate, that we do foster a strong employment market.
Is part of that a more diverse workforce at the Fed?
So as you know, we work very hard to achieve diversity, and as all major American institutions, public and private, do these days, we certainly do, and we think that having a diverse workforce it makes us better at doing our jobs, and so it's an important focus and a high priority.
Okay, thank you, Senator Toomey.
Thank you, Mr. Chairman. Chairman Powell, we all noted with great interest the shift in the Fed's focus, the acceleration of the tapering, and the indication that FOMC members expect now a series of interest rate increases this year. I'm trying to understand where this leads to, and I wonder if you could comment on the fact that if we had 3 or even 4 25 basis point increases in overnight rates, we would still, in my view, have a very accommodative stance with negative real short-term rates. Is it your view that it's realistic to bring inflation back to the target level if short-term interest rates are negative, real rates?
So the way I would look at it is this. What we have now is a mismatch between demand and supply. We have very strong demand in areas where supply is constrained, particularly around goods, particularly around things like cars. So we have to, how are those two things going to get into better into alignment? Well, part of the answer is going to be through shifts in demand, and we think that part of it will be through the return of greater supply. So I don't think we look to get all of the realignment between demand and supply through the demand channel, although we should get some. But at the same time, we do think we'll get, over the course of this year, return to normal supply conditions, and that's going to affect our policy. I will say, though, if we see inflation persisting at high levels longer than expected, then we will, if we have to raise interest rates more over time, we will. We will use our tools to get inflation back. And the main reason is this, that to get the kind of very strong labor market we want with high participation, it's going to take a long expansion. We can see that participation is moving only very slowly. And to get a long expansion, we're going to need price stability. Right. And so in a way, high inflation is a severe threat to the achievement of maximum employment and to achieving a long expansion that can give us that.
I think that's a very important point. Let me also just ask you, as I mentioned, I understood the need for quantitative easing, the extraordinary measures that we're taking during the crisis, but I worry that the Fed's decision to continue to use these policies well after the crisis had passed, and in fact we're in the midst of a strong recovery, increases the risk of normalizing behavior like this bond buying. So I think it's your view that it's important that this not become normal routine part of Fed behavior. But could you clarify that? And if it is important that this not become a routine matter, how do we ensure that it doesn't?
So I guess I would start by saying that the last two downturns there's been nothing normal about them. They've been two historically large downturns, one being the global financial crisis and one being the pandemic. And we were called to invent new tools and use all of our tools. If we had a regular way recession, a couple of quarters of negative growth, a typical recession, then the question would be, what do we need to do? And so in this era of very low interest rates, there's not going to be as much room to cut. But that would be the first thing that we would do. Now, just because we have been and probably remain in an era of very low interest rates, we would have to look at asset purchases as the next tool in line, but I don't think we'd automatically use it unless it was necessary.
I would certainly hope we wouldn't automatically use it. I would hope that there would be a very, very high threshold to get over, especially when you consider the ways in which it distorts the allocation of capital. As I mentioned in my opening remarks, one of the things I'm very concerned about is especially the regional banks having strayed from the Fed's statutory mission on monetary policy into inappropriate and overtly political advocacy. Just one of many, many examples, the Boston Fed conducted a virtual event as part of its Racism and the Economy series, in which the speakers routinely and adamantly called for defunding the police. Just nothing to do with the Fed's mandate. For 7 months now, I've been asking for information from several regional banks about their political activism, and for 7 months, they have simply refused to comply with my request. So I've requested some documentation from the main Fed with respect to this activity, all of which, by the way, is subject to FOIA in any case. Now, I'm sure it's not your opinion that the ranking member of the Senate Banking Committee is entitled to less information than a member of the general public would get through a FOIA request. So can you commit to getting me the information that is now long overdue?
So I am aware that you have submitted a FOIA request and we're processing it now, and I don't know what's asked for. I don't know whether it's actually covered by FOIA, but to the extent that it is, you'll, of course, get it.
I think it's very important that this committee and Congress understand how the Fed reaches decisions to engage in political advocacy. Thank you, Mr. Chairman.
Senator Toomey. Senator Reid from Rhode Island is recognized.
Thank you very much, Mr. Chairman. And Chairman Powell, congratulations on your renomination. I believe that President Biden has made two excellent choices, yourself and Governor Bernard. I think you've worked together hand in hand for many years. I think you'll be a superb team. And so I look forward to supporting your nomination and Governor Bernard's nomination also for vice chair. And let me join my colleagues in commending you for an exceptional job with respect to the pandemic. One of the interesting consequences of the pandemic and the employment market is that we've seen wages rise. In fact, we've seen them rise with respect to factory workers, non-supervisory personnel, about 5.8%. And my concern is, would an increase in interest rates in anywhere begin to slow down that rise or indeed reverse it?
So like you, and I think like everyone, we think wages moving up is generally a good thing. But if you look back through history, there are times when wages have moved up in a way that has fostered persistent inflation, and that hurts everyone. It particularly hurts people on fixed incomes. So we don't see that right now, but we do see these are the biggest wage increases in decades, and so we're watching carefully. And to the extent we are looking at this year, what we see is an economy where the labor market is recovering incredibly rapidly, really beginning around the end of the middle of last year. The unemployment rate's been dropping at more than 0.3% per month since last June. It's now below 4%, which is pretty close to half century lows. So that part of the employment market is doing very well. Meanwhile, inflation is running very well, very far above our target. And what that's telling us is that the economy no longer needs or wants the very highly accommodative policies that we've had in place to deal with the pandemic and the aftermath. So that's what that's really about. We're really just going to be moving over the course of this year to a policy that is closer to normal, but it's a long road to normal from where we are. Right now we are very highly accommodative, and it is really time for us to begin to move away from those emergency pandemic settings to a more normal level. It really should not have negative effects on the employment market.
Which it's ironic because, as you pointed out in your opening statement, when you took over, we had 11 straight years of significant economic growth, but that was not translated into the wages of most working people, particularly entry-level and non-factory workers, et cetera. And now we've seen a situation where that's reversed, and I would hope that we could continue that type of progress. And I know you'll be sensitive to that going forward. One of the interesting things about the situation we face now is that the Fed tools are probably most effective reducing overall demand. But a lot of what we're facing is supply problems. The situation about automobiles, the problem there, in fact, I think used cars are so expensive, they're distorting the inflation numbers significantly. And that's a result of a shortage of microchips and other types of chips, which is a result of the pandemic. These are supply issues. So to what extent will your dealing with demand help supply? And maybe that's the real problem.
No, it really won't. We really can't directly affect supply side conditions, and that's why I mentioned this really is a problem both of very strong elevated demand, particularly in a part of the economy, the goods sector, the durable goods sector, things like washing machines and cars and all the things that people bought during the course of the pandemic when they couldn't spend money on travel and services. That's where spending is running at a level 20% above where it was before the pandemic, and it's just kind of overwhelmed the supply chains, most of which are global. In these days, you're getting parts and fully assembled products coming in. So we can affect the demand side. We can't affect the supply side, but this really is a combination of the two.
Well, a final point I want to make is that the issue of climate change is absolutely critical. It's an economic issue. I don't think you want to see a lot of banks owning property that's literally underwater. But if you look at any of the analysis going forward, that could be the case. So I would hope that the Fed would view this as an economic issue and pursue it as an economic issue that's going to affect us dramatically. And my colleague, Senator Whitehouse, has been one of the most staunch visionaries and advocates for that position, and I hope the Fed is responsive. Thank you, Mr. Chairman.
Thank you, Senator Reid. Senator Shelby from Alabama is recognized.
Thank you, Mr. Chairman. Chairman Powell, welcome back to the committee. You've spent a lot of time with us in the past. Inflation is currently surging at its highest rate in 40 years. And while I appreciate the decision that the Fed has made to begin tapering, I'm concerned that the Fed missed the boat on addressing inflation sooner. A lot of us are. And as a result of that, the Fed, under your leadership, has lost a lot of credibility. I only have a little time, so I have a number of questions, and I know you can probably remember them, but maybe together we'll remember them all. But I'd like to touch on this, if you would, I'd like for you to. Why did the Federal Reserve initially forecast inflation to be transitory? Secondly, has your view on the threat of inflation changed? Why? What assurances can you provide here today that the Fed has a better grasp today on inflation than a year ago and so forth? And what factors have caused the U.S. to have greater increases in inflation compared to other developed countries? And I guess lastly, yes, how important is price stability to the American people? And that's a lot of questions, but these are all relevant to your job. Thank you.
Respecting your time, let me go right through these. First, let me say price stability is half of our mandate. There's no basis in the law for preferring maximum employment over price stability or vice versa. They're equal. However, at different times, one of them is farther away from its goal, and that's the one we need to focus on a little bit more. Sometimes that's maximum employment. Sometimes it's inflation. I'd say now it's inflation. So on inflation, why do we say transitory? We said that because we thought that these supply side bottlenecks and shortages would be alleviated much more quickly than they have been. There's no empirical experience with this before. We haven't had the global supply chain collapse. We haven't had this kind of a labor force shock before. So we and essentially all other mainstream forecasters forecasted that by now we'd be seeing much lower inflation, and that's not what happened. So what's changed is that, just as I mentioned, the supply side constraints have been very persistent and very durable. We're not seeing really a lot of progress. If you look across, the global supply chains and what's happening domestically, look at our ports, look at Long Beach and LA, the two big ports on the West Coast for Asia. The number of ships at anchor is still at a record level. So we're not really seeing yet the kind of progress we essentially all forecasters really thought we'd be seeing by now, and that's really what's driving it. I think we did foresee the strong spike in demand. We didn't know that it would be so focused on goods, but so that's really what happened. And so I think we learned that it wasn't that it was just this is a unique set of circumstances. We haven't had really the United States economy is so dynamic. The supply side adapts quickly. And, there are new companies being started and old companies dying all the time. This is a situation where there actually are hard constraints. People want to buy cars. Car makers can't make any more cars because there are no semiconductors. So that's never happened. I can't think of another example of that, and that's true across. So what factors really? It's the supply side. Did I miss any? I like to think I covered, at least touched all five of those.
What have you really learned and you would share with your fellow Board of Governors to get a grasp as much as you can on inflation? Because a lot of us have been on the committee a while, and we remembered what Dr. Volcker did with the Fed under his leadership. And it was draconian, but it worked. I hope we won't have to do that, but you've got to do whatever you have to do. Do you agree?
We have to achieve price stability, and I believe we will, and I'm confident we will. And again, it's not just a question of restraining demand, although that will be. Right now, we're stimulating demand with very highly accommodative policy. As we move through this year, we will, in all likelihood, we don't know the future, but if things develop as expected, we'll be normalizing policy, meaning we're going to end our asset purchases in March, meaning we'll be raising rates over the course of the year. At some point, perhaps later this year, we will start to allow the balance sheet to run off. And that's just the road to normalizing policy. That's what we're going to be doing. Of course, we're committed. But we also we do believe, and I think widely it is believed that these supply blockages will be alleviated too, so that there will be more supply as well, more labor force. But people will be coming back into the labor force. We'll see more recovery, although it's been slow from participation. And we'll see these global supply blockages coming down. We'll see some more cars, although that's going to take some time. And that will help as well, getting supply and demand back at the same level.
Senator Menendez from New Jersey is recognized.
Thank you, Mr. Chairman. Chair Powell, let me start by reiterating a point that I've made, unfortunately, far too many times. And the latest batch of nominees leads me to, once again, the conclusion that there is a serious diversity problem at the Federal Reserve. Latinos are the country's largest minority. They make up nearly 20% of the entire U.S. population. It's outrageous that they have no representation in Fed leadership. There's never been a single member of the Board of Governors or regional bank president that has lived the experience of being a Latino in the United States. And that means that the voices of 1/5 of the country's citizens are repeatedly drowned out when the Fed is making critical decisions on economic policy, decisions that affect whether a Latino family can afford their first home, find a job that pays a living wage, send their children to college, save for a comfortable retirement, or get a loan to expand their business. In late October, several of my colleagues and I sent you a letter requesting that you work closely with the Boston and Dallas banks to recruit diverse candidates for their open president positions. We received your response to that letter just last week, and I have to be honest with you, the lack of detail is thoroughly disappointing. I'd be expecting you to provide a more detailed update on the search process before your confirmation vote, including what specific changes you've made to the process and how they're going to lead to a more diverse candidate pool, and I hope that you will do that. While we face significant challenges with the Omicron variant and supply chain disruptions that are both causing families to face higher prices for a variety of goods, the fact is that we're experiencing a strong recovery from an unprecedented pandemic. Thanks to the American Rescue Plan and other policies put in place by Congress and the Biden administration, we gained an average of 537,000 jobs per month since President Biden took office. So, Chairman Powell, if you're confirmed, how would you continue to balance the Fed's dual mandate to keep price increases manageable while not dampening the strong job and wage growth that we've seen over the past year?
So by so many measures, labor demand relative to supply is at its highest level, really, that I can remember. The level of job openings is at an all-time high as a percentage of the labor force. The level of quits labor economists look at the level of quits as a real indicator of how strong the labor market. The percentage of quits, the number of quits, is at an all-time high. So the problem is not lack of demand for labor. The problem is that there's a significant supply problem, which is associated with the pandemic and a range of other factors. Participation has not recovered, but as you can see, for people who are in the labor force, the unemployment rate is dropping at historically fast levels. So we don't have a labor demand problem to solve through our policy. What we have is a labor supply problem. So what is the threat? We're clearly on a path to have an even better labor market over time. What are the big threats to our getting there? Well, I would say right very near the top of the list is the threat of price stability. If inflation does become too persistent, if these high levels of inflation get entrenched in our economy and in people's thinking, then inevitably that will lead to much tighter monetary policy from us, and it could lead to a recession, and that will be bad for workers. So really, achievement of maximum employment, by which we really mean continued progress in hiring and in participation, is going to require price stability, and that's going to require us to use our tools to the extent they work on the demand side, while we also expect some help from the supply side.
Do you expect inflation to subside as vaccinations increase and supply chains are repaired?
Over time, yes. Over time. The question is how fast, and the risks that we're running in the meantime that inflation psychology starts to get entrenched. But certainly I believe that. And you make a great point about vaccination. Getting ahead of the pandemic, I mean, I don't think 2 years ago we thought we'd still be having record levels of cases and even close to record levels of hospitalizations. Getting past the pandemic is the single most important thing we can do.
Now, finally, according to the New York Times, New Jersey and other parts of the Northeast were hit particularly hard at the beginning of the pandemic and during the most recent surge, while the Midwest was most strongly affected in November of 2020 and the South at the end of last summer. How closely does the Fed look at differences in regional performance when making policy decisions?
We have to focus on the national level, but of course we follow, in this instance, the earlier Delta, for example, COVID rolled around the country on a regional basis. That's not so much the case with Omicron. It's so contagious, and it's not the same everywhere, but it really is going through the whole country at a pretty rapid rate. But we follow that very, very carefully. You know, I would say we didn't know much about vaccines and pandemics 2 years ago, but we've all had 2 years to learn. So, but we defer to the experts, though. We don't substitute our judgment on medical issues for the experts, but we talk to them all the time.
All right. Well, I look forward to following up with you on the diversity question. Thank you, Mr. Chairman.
Senator Crapo is recognized from Idaho from his office, I believe.
Yes, thank you, Mr. Chairman. And Chair Powell, welcome back to the committee. When you last appeared before this, I also asked you about an expected Fed report on digital currencies. You indicated that delays in releasing the report were because the Fed wanted to ensure that their analysis was correct and to complete, and that a release was expected in the coming weeks. However, that report still has not been released. Do you have an update you can share on the status of the report? And are there problems with sharing this report report with Congress and the public and what the Fed may be proposing with respect to possibly centralizing public digital currency?
So the report really is ready to go, and I would expect we will drop it. I hate to say it again in coming weeks, but it really is in a situation where it's ready to go. The fall for us, given changes in monetary policy and other things going on, it was hard to we didn't get it quite to where we needed to get it, but it's effectively there now. And I will tell you, it's within weeks we will be publishing it. And by the way, it's more going to be an exercise in asking questions and seeking input from the public rather than taking a lot of positions on various issues, although we do take some positions.
All right, thank you. Well, as I hope that you'll be able to meet this couple of weeks projection. As you know, I've been asking you and other members of the Fed about this for a long time, and I really do believe it's time that the Fed release this report so that we can engage in the further discussion of it. I want to also, with the rest of my time, go back to the issue of inflation. I know you've talked about it a lot with us this morning. In response to my questioning about inflation last November, you confirmed that inflationary pressures would certainly last in your work through the middle of this year, of this coming year. What do you now expect with the time we've seen since you last answered these questions in front of the committee? What do you now expect inflationary pressures to look like throughout this year?
I wouldn't say things have changed much on that front since last November. I think that inflationary pressures do seem to be on track to last well into the middle of next year. And if they last longer than that, then I'll just say that our policy will continue to adapt. Our policy has been adapting to this, for some months. But if inflation is going to last longer, then that would potentially imply more risk of its persistence and ultimately becoming entrenched, and our policy will respond accordingly.
You just said well into the middle of next year. Did you mean this year or through all during the next year?
I meant this year. You're right. I still think it's 2021 sometimes.
Hey, I thought so, but I wanted to be sure what you were saying. With regard to the question of what's going to happen over the next 3 to 4 months as we try to deal with the inflationary pressures you've described, if consumer price inflation were to persist over the next 3 or 4 months at somewhere between 5 and 7%, as we are now seeing, and if the unemployment rate were to remain about where it is now, below 4%, what would you expect the tools that the Fed would need to use would be? And I noted in one of your responses on the inflation issue earlier today, I thought I heard you say that the Fed's overnight interest rate would still, even after you may use it as a tool, would still be very low. Could you just discuss I know you can't predict with specificity what the Fed would do, but could you discuss what you expect interest rates to look like as you utilize that tool?
Sure. So I think to your point, we're at a place where unemployment is now very low, historically low, and inflation is well above target, and the economy no longer needs this very highly accommodative stance of policy. And I would expect that this year, 2022, will be a year in which we take steps toward normalization. That will involve raising the federal funds rate. That will involve ending asset purchases in March. And perhaps later this year, depending on the run of things, we would also see ourselves beginning to allow the balance sheet to shrink. So that's what I think that's the broad picture of what I see happening. The committee hasn't made any decisions about the timing of any of that, and I think we're going to have to be both humble and a bit nimble here. If you go back and look at where we were a year ago today in the economy, vaccines were arriving. I think that in my thinking there was the idea that'll really help us get past the pandemic, and it has helped a lot, but yet we're at all-time record cases and approaching record hospitalizations nationally. So the thing has stayed with us longer, and I think we're going to have to be open to the changing environment, and monetary policy is going to have to adapt as we learn more. And then we're going to learn a lot about the path of inflation, particularly as it relates to these supply side blockages we've had over the course of the first 6 months of the year and every month, really.
So do I understand, are you saying that if the pandemic remains problematic and aggressive, that would impact the timing of any decisions the Fed might make in terms of the federal funds rate?
So I'd say it could, but what's happened is the economy has made all these gains in the face of during 2021, we had two major pandemic outbreaks, two variant outbreaks, and really the beginning of 21 was dominated by a very strong wave of the original COVID. So, and yet the economy, we made tremendous progress in the labor market in 2021, and growth is at a multi-decade high in 2021. So I expect the economy to continue to be able to deal with these outbreaks. I think it is likely, though, if the experts are right and Omicron is going to go through really quickly and peak perhaps within a month and then come down after that, I think it's likely you will see lower hiring and perhaps a pause in growth and that kind of thing. But it should be short-lived. It should be. And then the economy, the forecast for the rest of the year, or certainly for the next quarter or two, would be a very positive one. Very positive.
And if that happens, would that increase the likelihood of Fed action to increase the federal funds rate, or would it delay that?
If that all happens, I think what we're seeing is an economy that functions right through these waves of COVID, and my colleagues and I see that, and you see that every quarter we write down projections of interest rates. They're individual projections. They're not a committee plan or anything like that. But broadly speaking, all members of the committee see interest rate increases coming this year. The median was 3. But that's going to depend on data. It's going to depend on the progress we see on the supply side, the progress we see on inflation. And we honestly don't know. There's risk on both sides, really, on growth and potentially on inflation as well. So we're going to have to be just very attentive to what's happening in the economy and willing to adapt pretty nimbly our policy as we go through the year.
Well, thank you, Senator Crapo. Senator Tester from Montana is recognized.
Yeah, thank you, Mr. Chairman. I don't know if there's any way to turn that mic down, but that was almost painful. I mean, it was tough. Not your questions, Crapo, just the intensity. First of all, Chairman Powell, I want to thank you for your willingness to serve. I appreciate your work that you've done working with the Federal Reserve Board throughout the health and economic crisis that we found ourselves in. And just to say, as many have said before me, we appreciate your steady hand. In your opening statement, you talked about climate change and cyber attacks, taking those into account as part of the things the Fed has to do. There was an interesting story in the Post yesterday that talked about $145 billion this country spent on disasters in 2021. December was the warmest ever, and last year was the 4th warmest year in history. And I think that's a conservative number because I don't think it took in the impacts of our crops and crop insurance and things like that. I say that because I hope you will continue to gather as much information as possible about what needs to happen as this climate situation appears to be getting worse and not better as time moves on. The American taxpayer deserves that. Look, the challenges that we've had because of this pandemic, it's fair to say that the Federal Reserve has helped us get through this in a major way. This question has been asked before, but I'm going to ask it again in a different way. Could you compare the economy pre-pandemic, pandemic a year ago, and today, and tell me where we're at in relation to those 3 different points in time?
Sure. So the pre-pandemic economy, that was a very long, historically long, 10 years and 8 months expansion. Growth was just modestly above potential. every year. So we were getting growth between 2 and 3%, and we think potential growth is around 2%. So that implies a tightening labor market. So we had this long, relatively uninterrupted period of growth, and what happened is unemployment kept coming down and participation kept coming up, and that was very beneficial. And you saw people around the edges of the labor market getting more wages. We saw companies going to prisons and recruiting people who weren't going to get out for a couple of years. I mean, it was it was a great labor market. So that's pre-pandemic. So then the pandemic comes and it upends everything. So the question really is, how's it going to be different? And we're only beginning to see that because we're not out of the pandemic. We're a long way from out of the pandemic potentially. But so what are some of the things that we're seeing that are with us now? One of them is that the recovery in labor force participation overall has been slower than hoped. Actually, prime age labor force participation has moved up a full percentage point almost last year, but overall that was offset significantly by older people retiring, older people and not older people retiring. So we're seeing some differences. We're going to see people working remotely. There's the wage increases that we're seeing are still very skewed to the lower end of the income spectrum. So there may be something happening there where wages are just going to be higher for people, and we don't know whether any of this will persist. But some of those are some of the things that we're seeing. I know employers who are hiring younger people out of school are finding that they have to have one day to work from home, or they'll go to someplace else where they can get that. So it's a market right now where labor is very short. And as a result, workers have a lot of leverage, and that may persist. So I think there's a lot of different things.
I've just got a limited amount of time here, but could you speak a little bit about the importance of the independence of the Fed? I remember pretty clearly the kind of pressure that was put on you by President Trump to try to politicize the Fed. And I commend you on keeping it independent. Could you talk about why that's so important?
Sure. So it's essential that we work for all Americans, and that's what we do. And it's essential that we do that without regard to political considerations like election cycles or particular political parties' views on issues that are outside our mandate. You know, we have to focus on the job Congress has given us, which is maximum employment and price stability, and also the payment system and financial stability and other things. But we've got to do that, and that is what we need to do to justify our continued independence, and we're committed to doing that.
Thank you, Mr. Chairman.
Senator Tester. Senator Rounds from South Dakota is recognized.
Thank you, Mr. Chairman. Chairman Powell, first of all, let me congratulate you again on being selected to serve a second term as the chair of the Federal Reserve, and I do look forward to supporting your nomination. I want to follow up a little bit with regard to the discussion on inflation. And consumer price index rose 6.8% in November. There appears to be a consistency along that line. Part of that you have the opportunity to impact with regard to the demand side. Can you talk to us about your discussions, or at least your analysis, of how much of the inflationary trends we're seeing you have the ability to impact with your monetary policy?
So we don't have much ability to affect the supply side. And if you look at where the really big contributors are to the overshoot from inflation, it's in the goods sector still largely, and that's cars, that's new, used, and rental cars. It's appliances and
what about food?
Goods. Food too.
Hamburger at over $5 a pound.
Yeah, no, and that's not something we can't. I'd say that there are supply side issues there too, as you and I have discussed, but those are really outside the range of our.
Be fair to say
tools.
Petroleum products as well.
Yes.
Gas, price of gas at over $5 a gallon. Those are items that are supply side. They're not the demand side, and yet
that's right.
You have a responsibility to try to, or at least your goal is to remain inflation at about 2% or so.
Right.
But the supply side of this is a significant part of the entire inflationary demand. Fair to say that your focus is on the demand side, not the supply side, correct?
That is right. That's correct.
So what percent of that inflationary trend, what percent of that are you trying to impact with the demand side monetary policy that you have the ability to impact?
It'd be hard to break it down in that way. I would say it this way, though. Right now, our policy is very highly accommodative, so we're stimulating. We're not restraining demand at all at this point. We're encouraging it. We're trying to get to a place where we're more neutral and then perhaps tight if that's appropriate.
But it's not political in nature. It is economic in nature to say that the inflationary trends that we are seeing are partially from the ability of consumers with cash in their pockets to be able to pay a higher price. But second of all, it's because of the limitations and the bottlenecks that we find within the supply side of our economy, correct?
Yes.
So let's just take food as an example. I come from South Dakota where cows outnumber people, and yet we have producers there that on a regular basis talk about the fact that they don't see an increase in what they're receiving for livestock, and yet our consumers across the entire country are seeing huge increases in the price of meat. And in between them sit packers, four packers who control over 80% of the market, showing record high profits while consumers pay huge inflated prices. That's something which has to be dealt with policy and not necessarily something that the Fed can impact, correct?
That's really a competition policy question, yes.
Yeah. So do we have the same type of challenges with regard to other items that people consume on a daily basis? And by that I mean petroleum products are something that I truly believe that the price rise in petroleum in 06, 07 really impacted the ability of people to actually pay their mortgages or pay their rent, or for that matter, they were going to put food on the table before they were going to pay a mortgage. Do we have a similar type of situation developing here with regard to individuals that are trying to get to work, paying a higher price for their gasoline, and now they're seeing the possibilities of other things going by the wayside?
That is right. I mean, gas prices are high, and those gas prices and food prices are, and heating oil prices, are the kind of things that affect people who are living paycheck to paycheck on a fixed income.
And not necessarily something that you can do at the Fed, but nonetheless, it does impact inflation, and it's something that would probably have to be addressed with the regulatory environment that we have within this country today.
We can have marginal effects on demand, but we really, when it comes down to energy and food, those are largely importantly influenced by supply side issues.
Thank you. And I would just add this. I know that with regard to regulations, the Fed has been considering whether or not to make permanent adjustments on a separate item to the supplementary leverage ratio, or SLR, in order to account for a significant influx of cash that consumers have got. They're trying to put them into banks, and yet banks have to basically have capital to be able to accept those deposits. I would just hope, and I would consider that you continue to look at considerations with regard to the adjustments on the SLR, so that we actually have the ability to accept those deposits in the future, sir.
We will return to that. We want risk-based capital to be binding, not the leverage ratio. We do want to make adjustments, but we want them to be done in ways that don't reduce the overall bindingness of the capital requirements on the largest firms. That's an important principle. But within that, we do think there's some things we may be able to do on the SLR that honor that first principle.
Thank you. Thank you, Mr. Chairman.
Senator Warner from Virginia is recognized.
Thank you, Mr. Chairman. And Chair Powell, let me join my colleagues on both sides of the aisle in thanking you again for your service. I want to pick up a little bit where my friend Senator Tester left off when he started talking about pre-pandemic economy, pandemic economy, and post-pandemic economy. You said in your testimony that the post-pandemic economy is likely to be different in some respects, and that, quote, the pursuit of the Fed's goals will need to take these differences into account. What are some of those differences? You mentioned we're seeing changes in employment patterns. We may need to see new supply chains. Can you talk a little bit more about, in that post-pandemic economy, what those differences will be, how it affects the Fed's decision-making, and will there be actually any economic indicators that might be have a new emphasis or even be new economic indicators in this post-pandemic economy? Hopefully we get to.
We're just beginning to see this sort of emerging from the fog, so it's all very indefinite. But you mentioned supply chains. The supply chains we had pre-pandemic were very efficient and pretty fragile. And so I think companies, since the very beginning of the pandemic, have been looking at ways to have more robust supply chains that won't be, subject to these kind of disruptions that we've had now for 2 years. That's one. Another I mentioned earlier is labor force participation has been much slower to come back than we had hoped for. The level of employment that's consistent with price stability is something that can evolve over time, and we have to deal with the economy as we find it. Right now, we have very high inflation and wages at multi-decade highs, which are not causing the current inflation at all, but something that we're watching. And we want participation to come back, but it's been quite slow. We have to deal with the fact that it probably will take a long expansion to draw people back into the labor market. Just to speak of two, there are many others.
Well, for example, would childcare be one of those factors? We still have a large percentage of the workforce, particularly women in the workforce's participation, is still down. If we don't find a way to provide adequate, affordable childcare, is that not going to be a long-term disruption? It's
clearly weighing on participation still, although participation has moved back up among women as well. But that part of the economy is suffering from a lack of workers as much as any part is, and so that weighs on participation by people who depend on childcare. Yes.
I also think that on the supply chains, we a lot of us at the beginnings of this pandemic raised concerns about being dependent on sole source, for example, whether it's the base chemicals that go into our pharmaceutical drugs or PPE coming from China. I think some of these changes are going to be permanent. We now at the Congress needs to act to make sure that we don't maintain that dependence, but something I think we're going to need to continue to revisit. I want to come to another topic that you and I have talked about a long time. Out of the pandemic, we saw a disproportionate effect on minority communities. We lost 440,000 black-owned businesses. A lot of the delivery mechanisms that we put in place on the Paycheck Protection Program, well-intentioned, but clearly minority-owned businesses didn't do as well. I'm a big believer, and I thank folks on both sides of the aisle. I want to particularly call out my friend Mike Crapo on this. We got a lot of money into the CDFIs and MDIs, but there still remains challenges for these organizations. For example, in light of after the murder of George Floyd, private sectors indicated they were going to put up about $200 billion to help deal with racial wealth gap issues. But we continue to hear that there are a number of entities that might want to, for example, invest in MDIs, minority-owned depository institutions, with no intent of changing control, but they can't make those investments because of potentially triggering that regulation on change of control. I think we're going to need some regulatory review here. I think as well, we need to look at, for example, a non-emergency discount window that would be geared towards CDFIs and MDIs, modeled after the seasonal discount windows that already exist on a non-emergency basis. Can you speak to how you and the Fed can work with me and others on this committee to make sure that CDFIs and MDIs that are going to continue to play, I think, an increasingly important role in serving underserved communities don't get blocked by some of these regulatory barriers?
Yeah, so we've talked about this a lot. We're very focused on what we can do to support CDFIs and MDIs. We did see in the recovery from the pandemic, in a number of cases where they were the ones who were there in poor communities delivering credit, and to a great extent. So they were in some cases pretty effective. Nonetheless, so what are we doing? As you know, under ESIP, we've been working with the other banking agencies to make sure that those loans and investments can be made in a way that gives attractive capital treatment. There's a range of things that we're doing. We do want to foster investment in CDFIs and MDIs under the law. And
I would just ask that we can continue this offline, but for those entities and private capital that wants to come into these institutions with no intention of trying to take over control, whether we set up a different class of stock or some ability for the private capital to flow into these without triggering the change of control requirements that, frankly, at this point prevents a lot of those investments